Hooty hoo, all my stock market gamblers. Welcome today. I'm Tall Mike. I'm so glad you're here. Well, what's gone on in the market lately? Well, we've had three down weeks in a row, right? Okay, the S&P has come down 6% off the high. The Nasdaq's come down about 8% off the high. Now, are we going to get a bounce in the market? Are we going to just keep free falling and continue lower? My take is we're actually going to get a bounce in the market. Now, I'm a technical trader, and I'm going to try to explain some of this here. But anyways, on a technical basis, the market is oversold at this point, right? Down 6%, down 8%. We're getting to an oversold position. Now, what are we coming down to? We're coming down to what's known as the 20-week moving average. Now, normally in a drop like this, you come down, you tag it, and you bounce off of it. Now, you don't go up and make new highs. You make a lower high, and then you come down and challenge the 20-week moving average again. And eventually, you're going to fall below the 20-week moving average. On a daily chart, we're down below the 20-day, down below the 50-day. Now we're sitting right above the 100-day, right? And the 100-day, you could be a place where you bounce off of the 100-day. That's, right around 49.50, let's call it. Okay, so you're there, you're bouncing off, and you're coming up, and you're making a lower high, and then you continue lower. But eventually these resistance point where there's support, these are now support, they're going to break down. You're going to come all the way back down. In my take, you're going to drop all the way back to the 200-day moving average around 46.50 on the S&P, which is about 300 points lower from where we're at now. So you got a long ways to go. Well, 300 points, if I consider that quite a drop, a little farther to go, but that put you down again at the 200-day moving average. And I do think we'll get there. Now, this is just how I look at things from a technical side of things. Now, back in October, where were we? We were around 4,050, right? And we rose all the way up to 5250. So 4,050, 5250, 1,200 S&P points, right? I say we're going to give back half of that. That's what's known as a Fibonacci retracement level. 50% drop of the run-up we've had from 4,050 to 5,250 is 1,200 points. So I say we're going to drop 600 points from the high, which was at 5,250. We're going to drop 600 points, which would bring us down to about 46.50, which would bring us down to right about on the 200-day moving average, and we'll probably bounce off that again. So we'll bounce off the 20-week where we're at right now, go up, but eventually we're going to break that 20-week. We're going to come down and tag the 200-day moving average, and we'll see if that holds. Now, we could drop through that also. But right now, I still think we have farther to go on the downside, but use caution because I do think we'll get a bounce from here. I think we'll bounce off of the 20-week moving average. This is just my take. Your take could be completely different. All right, let's get over to some other things I want to talk about today. Here was a quote that came out, right? Okay, the American dream of owning a home is vanishing. American dream of owning a home is vanishing. Now, this came out from the U.S. Government Accountability Office, which is kind of funny because I don't think the U.S. government is accountable for anything. But this quote came out from that office. U.S. Government Accountability Office says the American dream of owning a house is vanishing. Okay, well, when was this quote made? This quote was made back in 1978. 1978? That's a long time ago. What were houses selling for back then? Well, the average price home was approximately $44,000. $44,000 in 1978 when the dream of owning a house was vanishing. Now, if you had bought one back then in 1978 for $44,000, you'd have 10x your money, right? Average price home now about $400,000. So gone up about 10 times since 1978. I don't even know if we still have the U.S. Government Accountability Office or not, but that was the quote back then. Now, do I think the American dream of owning a home, of home ownership, do I think that's vanished? Do I think it's going away? I do not. But here's what I do think. I do think it's a terrible time right now to be chasing that American dream. I think you're going to have a lot of opportunities. Maybe it's a year from now, maybe it's 2 years from now. But this market is going to correct. It's going to reset. It's going to reset to the downside. I think the American dream is alive and well. It's just gotten too far carried away right now. Things have to reset. You're going to see a lot of pain, a lot of suffering in the reset. I agree with that. People that are buying homes right now, I believe they're going to be hurt. I think they're going to be hurt really bad. We'll see how that plays out. You have Moon Boys say they're going to double from here. Barbara Cochran, they're going to double. Dave Ramsey, they're going to double. You can go listen to them. I'm saying you buy now, you're going to be the bag holder. But there is going to be opportunity coming. Be just on demographics alone. Now, okay, I want to talk a little bit about the debt to GDP ratio. So in 1978, you could buy a house for $40,000, right? $44,000. Okay, and today it's about $400,000 for the average home. Now I'm going to pull out my high-tech graphics because I know everybody likes my high-tech graphics here. Okay, this is a chart of the debt to GDP. Now back here in around the 1978 when we're talking about, the debt to GDP level was basically 30%, right? Debt to GDP, 30%. But as you can see, it didn't stay that way. Where we're at now, we're up around 130% debt to GDP level. Debt to the national debt to the GDP, the gross domestic product, right? Okay, so the GDP, now you'll see how it spiked up here in COVID, and then this came down to about 120%, but we're headed back up to 130%. Now what happened? Well, the GDP, it got a little bit better, right? It got a little bit better. Now, some people, the Biden administration will tell you that the GDP got better because the economy is doing so well. I'll tell you that's not the case. The reason the GDP increases is because of inflation. You inflate 20%, the GDP goes up by 20%. You take out that inflation, the GDP has been dropping, right? It hasn't been increasing. But you see, inflation can make the GDP actually go up and the numbers look actually better. Makes the economy look like it's doing better than it is. When they come out, for example, with the retail sales number, they go retail sales increased by 4% year over year. Oh, that sounds great. How much was inflation? Well, around about 10%. So really, the retail sales went down by 6%, but that's not what the mainstream media is going to tell you. They're going to build it up. And I like to take the positive side of things, but you got to be realistic about things also. You see, inflation can make that GDP number look really good, but it can also make things bad, right? It makes things bad because they're taxing you on everything. They're stealing your money. When inflation's at 7-8%, which I believe it is, if not already higher than that, they're stealing your money, right? They're taxing everything. Taxing everything you spend, everything you make, and everything you have saved. It's a tax, right? And it can also make the GDP numbers look better than they are. So when I talk about the debt to GDP ratio at 130%, basically, this is going to end in disaster. Disaster. It's going to be painful. It's going to be ugly. Now, but you say, but Mike, there are 10 countries in the world that have a worse ratio than we do. That's true. This is a worldwide problem. There's too much debt in the world, and when this debt bubble blows, it is going to be one ugly thing. But the good news will be that the American dream comes back to life, because house prices, what will they do? They'll be chopped in half, and that might be conservative. Half just brings us back to pre-pandemic numbers. They might get chopped by a lot more than half. Now, what I want to talk a little bit about is the wealth transfer. Everybody talks about the wealth transfer, and this is what is going to make home ownership affordable again, right? It's going to make homes come onto the marketplace. Homes will be for sale when the baby boomers start to check out. And a lot of us are getting older. They're getting to that age, moving into an old folks home, selling the house to get money to retire on. A lot of these houses are coming onto the marketplace, and some some of the millennials are stepping in to be the bag holders, right? Don't buy now. That's my take. You can do what you want. My take is to not buy now. Be patient. This market will crash. This market will come down. But you see, there's wealth transfer that everybody's talking about. Everybody says, well, the baby boomers, all that wealth's going to transfer to the millennials or even younger generations than that. And that's partially true. Now, if you are like, for example, if you're Jeff Bezos' kids or Warren Buffett's kid, even though Warren says he's not giving his kids the money, sure, you're going to get some of that money transferring down. But most of that wealth is going to be transferred. It's going to be transferred to hospitals. It's going to be transferred to old folks' homes. It's going to be transferred to insurance companies. It's being transferred to the cost of old age, if you will. You see, a lot of the boomers have money, but they're spending the money on health care, basically trying to live longer, right? Trying to keep them alive, even though they're not that healthy. Costs a lot of money for them to stay alive. So some of that wealth that's going to be transferred to the millennials is going to go away to the health care system, going to go away to the big pharmacies, right? Because the drugs are expensive, and they're charging the boomers a lot of money to stay alive at a late age. Okay, but here's the thing. You see, they're talking about the wealth transfer from the boomers to the millennials. What they're not talking about is the wealth transfer that already's happened from the millennials to the boomers. You see, the boomers, and I'm a boomer, so I can, I can sympathize with the boomers. See, the boomers, we say we worked hard, man. We earned every cent we got. We worked hard. We made it work. And these millennials, they're just lazy. They can't make it work in this system. They can't go out and afford to buy the house because they don't work hard like us boomers work. Well, you see, what us boomers did is we stole the money from the millennials. You see, the debt to GDP numbers will tell you. See, us boomers were here, right? And we just increase the debt that the millennials and younger generations are going to be responsible. You see, we stole the wealth from the millennials and the younger generations so that we could live above our means, so that we could live a lifestyle that we wanted to live. We didn't want to have any pain. We didn't want to have it to work hard. You see, the boomers, they'd say they're tough, right? They're tough, man. These millennials, they just are weak. They're lazy. They just want everything given to them. Look, we stole the wealth from the millennials. Okay, and we were really smart to do that, right? Because we're going to be dead and gone, and the problem, they're going to have to figure that out. $35 trillion we stole from, but it's worse than that. We stole Social Security and Medicare, another $120 trillion. So you're looking at $150 trillion with the T, of wealth that we stole from future generations, the millennials on down. The boomers stole that money, you see. Now, the wealth being transferred back to them, I don't think it's going to get back to them. I think big pharmacy's going to get it. I think the hospitals are going to get it. I think the old folks' homes are going to get it. Man, I know a lot of my friends, their parents are in an old folks' home, and it's pricey. Some of these have buy-ins, $250,000 buy-in to basically live in a glorified apartment. Yes, it's a luxury apartment, but $250,000 buy-in, and then they charge them $8,000, $10,000, $12,000 a month. And this is in the independent living side. As soon as you go into the fully assisted side, you're looking at $30,000 to $40,000 to $50,000 every month. Every month when they need the care. I'm telling you, this is a booming industry. You want to get into a booming industry, invest into old folks' homes. The boomers are getting old. They're dying off. They're going to have their homes coming onto the marketplace. More homes than the millennials will want. The prices will come down. The millennials will get the opportunities to live out the American dream, but we put them in so much debt. There's going to be a lot of pain for them, paying off all the bills that we accumulated because we think we were so smart, so hardworking that we were just, we stole their wealth. We stole their wealth. And we're continuing to do that, right? We're continuing to steal the wealth of future generations. Every time we print money, we're printing $1 trillion every 90 days. We don't have that money. We do not. What do? We steal it from future generations. Because my generation, I know me in particular, I don't want to feel any pain. I want to live above my means. I want a good life in my, older years, the golden years. I don't want to go backwards. I want to keep spending the money, right? So let's have those millennials pick up the tab for us. The millennials on down, we're sticking them with the tab. And we think they're so lazy. Maybe we were the lazy ones. Maybe we shouldn't have spent all their money. Maybe we should have left the world better than where we came in. This is just my take. I know I'm going to get a lot of hate on this one. I know a lot of you don't agree with this, but that's the way I see it. I'm Tall Mike. Get out there, everybody. Have a great day. Punch that subscribe button so we can talk later in the week. Bye-bye.